Duck Hunt. A brief look at some areas in finance theory and practice where integrity is lacking out of capitalism and society. Putting integrity into finance is purely a positive phenomena. What's happened? My name is Lee. We turn now to a discussion of the application of this purely positive theory of integrity to finance. We start with some common beliefs, recommended practices in theory and finance that are inconsistent with being a person or a firm or a system of integrity. We list here some of these propositions and provide a detailed analysis below. Consider the following: the long history of finance, not the law, of implicitly defining the fiduciary duty of managers to be current shareholders only, and therefore ignoring future shareholders and current and future bondholders and other claimants on the firm. As an example of this, we point to the common recommendation for managers with an overvalued stock to issue new stock at the current high or make acquisitions using overvalued shares as payment to benefit current shareholders at the expense of future shareholders and implicitly to hide what they are doing. Common budgeting practices and target-based compensation plans that pay people according to how closely they meet their targets. Managing relations with capital markets in a way that views financial reporting choices as strategic and must be made to both manage what the street expects to what the street to and to give the street what it expects, basically manipulation of the street. Each of these recommended practices is out of integrity and leaves the entity being out of integrity. That is, not whole and complete as to its word. These practices thus create unworkability and destroy value. I'm just running back to this first one. Common budgeting practices. So a budgeting practice and target compensation plans that pay people according to how closely they meet their targets. Interesting. Consider, for example, the common recommendation noted above for firms whose equity or debt is overvalued to sell stock or bonds at those overvalued prices. That out of integrity recommendation, oh, okay, got it. So you got to sell more to make more, and you're basing it off of this thing, this overvalue. That out of integrity recommendation, not whole and complete as to its word and bound to lead to value destruction. The same is true of advice to use that overvalued equity to acquire a less overvalued firm for stock, implicitly hiding what is being done. In both of these cases, the management of the overvalued firm is violating the firm's implicit word to its financial claimants that it will not intentionally take actions that harm them. This is an example of the situation where an individual or organization is out of integrity, that if that individual organization does not either one, comply with the expectations of their financial claimants, that they are unexpressed requests, expectations based on the firm's implicit word to its financial claimants, and even what it simply allows those claimants to expect, or two, explicitly and clearly decline those expectations. See the definition of word 3 or 4 discussed above in the section and more completely in the appendix, words 1 defined. So in addition to I don't know if the term was correct, but I heard someone say you don't have to keep your word. It's not a matter of that. It's you explicitly decline those expectations prior, or you just own it and clean up, as stated in the previous videos. When new share, and don't be upset about what you have to clean up for. It's like you, yeah, that's part of the, I know you didn't think that was part of the, gonna be part of the mess prior to you making that decision. I get that. And that's why shifting this whole thing to giving people the options to do something in integrity versus not is so effective. It'll make everybody way more money. When new shareholders discover that they were duped, workability will decrease and value will be destroyed. Even if the lack of integrity is never recognized, the executives involved in the unacknowledged manipulation will have diminished themselves as persons, and the firm will have diminished itself as a human entity. Note, however, that the law does not provide obligation of the firm to future bondholders and shareholders through disclosure rules and regulations, but consider the attitudes of sellers and of new users and investment bankers who console them. Few CEOs and few investment bankers who advise them to take seriously any obligation of the firm to future bondholders and shareholders when pricing a new issue. I got really moved just now noting that this is a paper for free anywhere you're online and is a Harvard Business School paper, which is free. And the Harvard Business not Harvard Business, Harvard study on nutrition as of recent is unbelievable. So, and then we have Harvard Online, which is offering seemingly all of their courses. Uh, I mean, it would take me forever to go through all of them, but I found what I was looking for. So that is free as well. So, a lot of these things people are like, oh, we want universal this or that. It's like, it is if you look for it and and you're not, and you're aware of your own judgments. When a CEO takes a firm public by selling shares or bonds to the public, he or she is creating a fiduciary relationship between himself and his or her company and the holders of those securities. The word he or she gives implicitly and explicitly to those purchases regarding the value of those securities is an important part of that relationship. That word must be given with the same standards as that of the fiduciary relationship as must sales creates. If the CEO or investment bankers speaking for the firm misrepresent, withhold information, or otherwise mislead those purchasing the securities, the firm is out of integrity and fiduciary relationship the transaction creates is sullied. Therefore, the ongoing workability of that relationship is damaged. We will continue on with the puzzling state of low integrity behavioral standards in corporations and capital markets. Trust your well. Let me know what you want me to see more of. Like Duck Hunt, very first game ever. For Nintendo. I'm sure there were what do you have before that? The Atari. Um Nelson Burt was the guy that did Chuck E. Cheese. Nelson Buswell. All right, hope you're having a good one. Bye.